Pre-tax contributions are a fantastic way to build up your retirement savings, but there's a potential downside. We're delaying the inevitable by not paying taxes on that money now. If we put this off all the way to retirement, you may find yourself with a massive tax burden that could seriously limit the amount of your savings actually making it to your wallet. Luckily, this situation is totally avoidable. In fact, by opting to pay taxes in a more strategic way ahead of time, you may be able to walk away with more money in your pocket throughout your retirement. In this video, I'll show you exactly how to do that. Hi, I'm Kenney, Wealth Advisor with the Noble Group. A lot of our clients aren't sure when they should be paying these taxes, but we've helped them understand what they need to do for their situation, and we'll help you figure it out in this video. One of the strategies I often utilize is called a Roth conversion. Now, this is simply the process of converting some pre-tax money into after-tax money by intentionally paying off those taxes we owe on those pre-tax dollars ahead of time. When we do this, the idea is that it's more advantageous for us to pay those taxes now and just get it over with rather than paying those taxes later when we want to start using that money in retirement. Now, I wish that I could say it's always better to pay those taxes before we start taking the money out, but it's not that simple. The good news, though, is there are 3 questions you can ask yourself that will help you determine whether you're in an ideal situation to make a Roth conversion. So the first thing we need to determine is whether it's more advantageous for us to pay the taxes now or later. When you move money from a traditional IRA into a Roth IRA, it counts as income. That means you'll owe taxes on it this year. But once it's in the Roth, any growth is tax-free, and you'll never pay taxes on it again when you take it out in retirement. For years, this decision was stressful because the tax brackets we were all using were set to expire in 2025. People were rushing to get conversions done before the deadline, worried that their 22% bracket was about to jump to 25% or their 24% bracket was about to go up to 28%. But that changed with the new One Big Beautiful bill, and I did another video covering the changes it meant for retirees that you can watch here. What you need to know for this video is that the law made today's brackets permanent. That means you don't have to panic about rates shooting up next year. You've got more breathing room to spread conversions out over time and do them at your own pace. On top of that, the new law raised the standard deduction to $15,750 for single filers and $31,500 for married couples in 2025. And if you're 65 or older, you also get an extra $6,000 per person deduction. That's $12,000 for a married couple. These deductions give you more room to do Roth conversions without moving into a higher tax bracket. So let's look at an example. Say you're a married couple, both age 66, with $50,000 of taxable income in retirement and $1.5 million in IRAs. Thanks to the higher standard deduction and your extra senior deduction, a big chunk of that income isn't taxed at all. You could convert up to $93,500 from your IRA into a Roth and still stay in the 12% tax bracket while keeping the full $12,000 extra deduction. Filling up the 12% tax bracket over the next 4 years until turning on Social Security at age 70 will save you over $450,000 in taxes during your lifetime. Compare that to waiting until age 73 when required minimum distributions, or RMDs, kick in. Your $1.5 million in IRAs at age 66 will grow for 7 years, and your first RMD could be over $80,000, and that's before Social Security or any other income. Suddenly, you're stuck in a higher bracket, whether you want to be or not, and potentially in a time when tax rates are higher. So the takeaway is this. Yes, today's brackets are permanent, but that doesn't mean there's no urgency. You still only have a window of time between when you retire and when RMDs start to take advantage of lower income years and these new deductions. Converting in that sweet spot could save you thousands over the long run. The second thing you need to think about is how Roth conversions affect more than just your tax bill. They can also impact things like your Medicare premiums and how much of Social Security is taxed. Here's how. When you do a Roth conversion, it counts as reportable income. If it gets too high, Medicare charges you extra, called IRMA surcharges. For 2025, the first level kicks in at $212,000 for couples or $106,000 for singles. Even if you go $1 over, your premiums jump. That can cost a couple $1,000s a year. Social Security is another area people don't always expect. The more income you report, the more of your Social Security becomes taxable. If you're a couple and your provisional income, that's half of your benefits plus other income, goes over $44,000, then up to 85% of your Social Security can be taxed. A big Roth conversion in 1 year could push you right over that line. There's also something called net investment income tax. It's an extra 3.8% tax that kicks in if your income is above $250,000 for couples or $200,000 for singles. Roth conversions don't create this tax directly, but they can push you over the limit, so it applies. Here's a real-world example. Let's say a couple age 66 has $10,000 of interest income, a $50,000 pension, and $60,000 of Social Security income for a total of $120,000, and they decide to convert $100,000, which brings their total income up to $220,000. Well, first, the net investment income tax is not applied to them since they are under the $250,000 of total income. However, since our income well exceeds the $44,000 provisional income threshold, 85% of our Social Security is going to be included as taxable income. That leaves them at a gross income of $211,000, staying just under the 2025 threshold of $212,000 for additional Medicare premiums. Just an additional $1,000 of income would push them into that next Medicare bracket, and they would have higher insurance costs in 2027. With that higher income from the Roth conversion, their tax bill jumps more than they expected as more of their Social Security is taxed, and they lose over $7,000 of the extra $12,000 senior deduction we talked about earlier because their total income pushed them into the phase-out range of that deduction, which starts at $150,000. This doesn't mean Roth conversions are bad. It just means you've got to size them right. Instead of doing one huge conversion in a single year, many people do smaller conversions spread out over several years. That way, they can keep Medicare costs stable and avoid making more of their Social Security taxable than necessary. So remember, Roth conversions affect more than just your federal tax bracket. They ripple out into healthcare costs and Social Security. You've got to look at the whole picture, not just one piece. The third big question to ask yourself is, what happens when I'm gone? Here's what I mean. If your kids or grandkids inherit a traditional IRA, they usually have to empty out the whole account within 10 years. There can be required amounts each year, but everything has to be out by the end of year 10. If your kids inherit a $1 million IRA while they're in their highest earning years, they might have to pull out $100,000 per year, all taxable on top of their own income. That could push them into a 32% or 35% bracket. A third of your money goes to the IRS instead of your family. Now compare that with leaving them a Roth IRA. They still have to empty it out within 10 years, but every penny comes out tax-free. They could leave it invested, let it potentially grow over time, and then take it all out in year 10. Or they could take a little bit out each year. Either way, there are no taxes, which means they keep more of what you worked so hard to save. This is where the new tax law helps too. With bigger standard deductions and the new senior deduction, many retirees now have more wiggle room to convert money at today's lower rates. Think of it as prepaying the taxes for your kids so they don't get stuck with a giant tax bill later. Some families take this even further and pair Roth conversions with estate planning strategies. For example, you might leave pre-tax accounts to charity, since charities don't pay taxes anyways, and leave Roth accounts to your kids. Or you could use a Roth conversion strategy to help fund life insurance that pays out tax-free. There are lots of options depending on your goals. The point is this: Roth conversions aren't just about making your retirement easier. They're also about protecting the people you leave behind. A traditional IRA leaves your heirs with a tax problem. A Roth IRA leaves them with flexibility. So when you think about whether a Roth conversion makes sense, it's a big mistake to just look at your own tax bracket today. Think about the much bigger picture: your spouse, your kids, and the legacy that you want to leave. So as you can see, Roth conversions can be a powerful tool, but they're not one size fits all. That's why we're here to help. We want you to be able to make a confident decision. There's a couple ways you can do this. You can reach out to us by email or phone to schedule a complimentary discovery meeting, or you can receive a complimentary video review from us by clicking the link in the description or scanning the QR code on screen. After you fill out a brief form about your personal financial situation, we'll review your information and send you your video. Thanks for watching, and we'll see you in the next video.